What I'd like to do is illustrate to you how the economy is tied into interest rates and how that can have an impact on you as you're out looking to consider refinancing or purchasing a house. And the most common place to come to this is if I were to look at the global investors and their opportunities to either be buying stocks or bonds. One way that I tie my business into the economy is stocks and bonds and the purchasing by the investors are affected by the economy, corporate earnings, unemployment, and various reports, which can give me indicators on where I think rates might be going. So it's my goal to set up a profile for each of my customers and watch economic trends so that if there's a moment where we want to lock you and get you into a very attractive rate that we don't think will be here in the future, I can take advantage of that. So I wanted to briefly just show you the difference between stocks and bonds. So if we put on our global investors hat and you're out buying and our marketplace is in expansion, kind of like what we saw in the 90s. Our economy is feeling very good. Unemployment is very low. Earnings are very strong. Consumer confidence is very high, and we're in an expansion mode. The global investors feeling good about all those key factors are going to be investing in stocks. Stocks are riskier, but they tend to have a higher reward for the investor willing to take that risk. So typically what we're going to find from stocks, you're in a very good economy, and there's great consumer confidence. Now if we look on the adverse side, kind of where we've been since 2005, 2006, all of a sudden our economy starts to stumble. Housing is faltering, unemployment is up to 10%, consumer confidence is extremely low, the market is very skittish and concerned, doesn't feel like the returns on the stock market will be there. The global investors will scurry or run to the bonds. The bonds offer a much lower rate of return to the investor, however they're very safe. So what I want you to think about in the bond purchasing is when we are in a bad economy, typically the bond market is doing very well and global investors are buying them. Now how this ties into mortgages are related to the bond market. So what you could think is when our economy is doing very poorly and bonds are soaring because people are fleeing to them for security, mortgage rates are going to be very low. When your economy starts to expand and there's a lot of confidence, you're going to feel that rates are going to start going up because people are going to stop buying bonds.